Okay, welcome everyone, and thanks for attending today's webinar on entry and exit do's and don'ts. And hopefully you can see me just to show you I'm real and I'm here. I'm not going to keep this on all the time, but I just wanted to say hi to everybody. And thanks for joining me. I appreciate it. Okay, so with that, we'll get started and got a lot to cover. Hopefully I'll keep it to about an hour or so, and you never know with questions, but feel free to send them along. Okay, so first of all, for those of you who are really not familiar with me, I'm going to go over briefly who I am, and then we're going to jump into it, what to do, what not to do with trading entries and exits, and then we'll have Q&A. So first, I just want to put up this disclaimer required by the U.S. government. Anytime we talk about trading and results and equity curves and all that good stuff, just realize there's a lot of risk involved in trading futures, trading options, any kind of trading. Hypothetical results can really throw you for a loop. Past performance is not indicative of future results. Just remember all those things. Okay, so for those of you not familiar with me, I trade full-time, but I also do some speaking, consulting, mentoring, teaching part-time on a kind of part-time basis. And I've been trading about 25 years or so. The last, I think, 11 or so, maybe it's coming up on 11, have been full-time trading. So I was able to make that leap. And this is me in December in a conference in Melbourne, Australia, which my first time ever in Australia. It was really a great time. So I've written a couple books, won a bunch of awards. If you're just getting into algo trading, you probably would want to pick up the book on the right. If you are a Kindle Unlimited reader, you can read it for free, actually. Otherwise, it's pretty cheap. And then a more intermediate book would be the one on the left, Building Winning Algorithmic Trading Systems. I wrote that. That came out about 4 years ago. And it's still pretty popular. And a lot of people use it and kind of go off and start developing systems. So those are some books I wrote. And if you stick around, I'm going to auction off one copy of this book to whoever gets the right answer to the question. So I'll autograph it, send it wherever you are, no matter where you are in the world. It might just take a little while to get there, but I can't control the mail. And if you subscribe to Technical Analysis of Stocks and Commodities magazine, you might have seen a new column that started in January. It's called Algo Q&A, where I'm going to be answering questions from readers on just algorithmic trading ideas, concepts. So if you have some, send them my way, and maybe I'll cover it in a future article. Okay, so that's who I am as far as the part-time, the teaching, mentoring kind of stuff. As a trader, I was in a trading contest 3 years in a row and finished in either first or second place. First place one time, second place the other time. This was a real money year-long trading contest. So as you can see, I was actually able to trade successfully. And the neat thing is the last two winners of this contest, I've also taught. I was in a master class in New York City where I was one of the instructors, and the 2017 winner, Stefano, and Petra, the 2018 winner, were both students in that class. So, the thing to think about is the things I talk about are more than just theory. They actually do work for other people. So just keep that in mind. So looking out my window, this was actually yesterday. On the top side of that fence is Lake Erie, and it's frozen. That was yesterday, 9 degrees Fahrenheit. Today, it's 46 degrees Fahrenheit, so it's gone up quite a bit, and the lake is no longer frozen. So it was like a quick freeze and then unfreeze, but that's kind of what you get where I am. Yeah, it looks a little chilly. That's right, Gary, but not anymore. It was kind of a little warm today and rainy. It's weird winter. Anyhow, that's where I'm at. Hopefully where you are, it's a little bit nicer weather. Okay, so enough about all that. Let's kind of get into things, what to do and what not to do. And just want to remind you, in case you have questions and I don't get to them today or I skip them over for some reason, just send me an email, kdavey@kjtradingsystems.com. I'm pretty good at answering all my emails. All right, now this webinar, you kind of saw on the title page, I had a copy of a book. It's called 9 Terrific Trading Entries, 7 Sensible Exits. You can go to my website and get this for free. You just have to sign up for an email list. You can unsubscribe anytime you want. So, you know, most of you are probably on a list already, but if you want to get on it and get that book, you can get it. And a lot of what I'll be talking about today kind of fits in with some of the entries and exits that are in this book, where you can take these entries and exits, combine it with what I'm talking about today, and you'll be, on the road to doing things right. Because a few of you have kind of emailed me and said, oh man, I'm just going to take all your entries and just optimize them over, all the periods and that kind of thing. And, I'm like, oh no, don't do that. So we're going to talk about that, like what to do and what not to do. But this will give you some good basis for kind of going forward in developing systems. So with that, do number one. This is something you always have to do. You have to build a strategy. And people might be, well, of course. But you'd be amazed how many people don't build a strategy. They guess at trades, or they start out with sort of an algo, some rules, but then they just go off and override it. The most important thing is you have to build a strategy. And what do I mean by that? Well, you've got to have an entry or multiple entries, right? An exit or multiple exits, and some kind of position sizing or money management. Now, a lot of this development work I do, I just assume one contract for the futures market. It makes it easy because you can see the edge a little bit. You're not messing up with money management and position sizing. Sometimes it's hard to see the underlying system if at the start of your back test you're trading one contract and at the end you're trading 50, right? But that's kind of the basics. So really, this one, position sizing, like I said, I just use a 1. So this equals 1 for at least now when you're first starting out building a strategy. Later on, you can get into the position sizing and all that. But, that's a good place to start. And then you go on and you look at each one of these blocks. So I look at them as blocks. You have your entry block. And of course, that's how you get in the market. You can get in differently for long and short. I don't recommend that because it tends to lead to some curve fitting, but there's some markets where that might be appropriate. Stocks, the stock indices, for example, you probably want to be a little more long biased than short biased. You don't have to be. You can also use the entries as exits, right? If you just stop and reverse. Most of my strategies are actually like that, where the entry is also an exit. So if I'm short, I'll exit the short and go long. You don't necessarily have to do that. You can have it where your exits control they're the only thing that controls when you get out. You can try different things, and you will get quite a bit of different performance by having stop and reverse versus not. So it's something to keep in mind. It's actually a different system. So what do I mean symmetric entries? Well, you could say if the close is greater than the close so many bars ago, you buy the next bar at the market. Then you flip it. You just say if the close is less than the close X bars ago, you sell short. That would be a symmetric entry. Those are nice because on a lot of markets, they tend to go up and down. They don't tend to go up and just stay up or vice versa. Things like, I'm thinking like currencies, for example, they go up and down and up and down. They just don't go up and take off forever usually. So if you're trading it, symmetric is a good way to go a lot of times. The asymmetric ones would be use a value of X to go long and maybe a value of Y to go short, where X and Y are different. And so that might be good for stock indices, for example, where the way you get in on the buy side is different than the way you get in on the short side. Hopefully you see that the big issue here is now you've got, for the same basic entry rule, you've got twice as many parameters. Instead of one parameter that you might optimize, now you've got two. So you got to watch out for that. And then, of course, all these are the way, this is Tradestation language, by the way. This is all stop and reverse. So this will exit your short and buy. So, and you don't have to do it that way. That's just one way to do it. And there is the stop and reverse. Or you could do it like this, where you say, if the market position is 0, if I'm currently flat, then look at entering. But if I'm already in a trade, don't enter new trades. So that's something to keep in mind as you're building your entry. You got to think, well, do I want to stop and reverse or not? And it actually might be two separate systems that you decide to test and see how they work, because they will work differently. And of course, exits, they can be real simple. They can be just the stop and reverse. You don't even need it. You could go back to this system right here. This is all you need. You could actually create a system with just these two lines, because you have a long entry, a long exit, short entry, and a short exit right there in 2 lines of code. That's pretty simple. But you can add stops, targets, all sorts of stuff, right? You can have technically based exits, time-based exits, different exits for long and short. The point is that's just one of your blocks to build a strategy. And here's just some examples. The interesting thing, a lot of people don't do the technically based exits. They usually just do stop loss and profit targets. And I'm one of those people too. But that could be a whole new field, whole new area for you to explore by, instead of just using stops and profit targets, well, maybe look at using some of your favorite entries, use them as exits with other entries. There's obviously a ton of different things you can do there. And then one of my overall favorites is still a time-based exit, where if I'm in a trade for so many bars, I just exit. That's a pretty good one. So that's it. You want to build a strategy, so you want entries, you want exits. And, you take the entries and exits that I put with that free book, try them out, play around with them, make the entries exits, do all sorts of stuff. And you could be testing for a long period of time. The only caution here is you just want to keep things simple. That's, the more complicated you get, the bigger your entry rules, or the more filters you have and that kind of stuff, usually doesn't work out too good. And then once you have a strategy built, something that you think is kind of interesting, you've got to test it. right? Because what's the point? You know, some people say, oh, back testing's bogus. And it's true, it can be. We're going to talk about that. But what's the alternative? It's to do no testing, right? And there's people out there who do that. I don't know how, because you come up with an idea. Just because you came up with an idea doesn't mean the market's going to think it's a good idea too, right? You're kind of at the mercy of the market. And remember, at the beginning I said past performance not indicative of future results. Absolutely true. But all things being equal, you know, would you rather have a strategy that you tested or not? Okay. My approach is to test and evaluate. And what I mean by that is I use the data and the facts to make my decisions. I don't play favorites with some kind of great entry that somebody told me worked. I test it for myself. And if I can't test it, I'm not going to trade it. I mean, you know, I've got to evaluate it and make sure it made money. Yeah, it's no guarantee at all that it's going to keep making money. But I kind of like that better than one that I know's lost money for the last 10 years. You know, why would you think that would all of a sudden start working? Doesn't mean it can't, just means it might not. And I see people sending questions. Keep sending questions. I will get to them at the end. So I just want to get through this and not kind of get off track. So just bear with me. All right. So here's an example. Let's just say you had a candlestick pattern. Pick your favorite candlestick pattern. We're going to call that event A. So you get a candlestick pattern and you want to, let's say, buy. How often when that candlestick pattern occurs does the price go up? That's event B, right? That's the reason you'd be buying, right? You want the price to go up. So you'd want to know that, right? Well, that's alternative A. You get your candlestick pattern, and then what if you knew that the price goes up 75% of the time? Okay, that's your one alternative. So you know it. Your other alternative is you have no idea. You just know your candlestick pattern, but you have no idea if it's going to go up or down. Which one would you like? Which alternative? Just type in A or B real quick and, you know, see what people like. Yeah, and you know, I kind of gave you an easy question. Everybody wants A, right? Except Antonis. He wants B, and then he says, "Ha ha." You know, if you're going off a candlestick pattern and you're hoping it'll go up, you'd like to know that historically that's what's happened. That's why you test. And that makes it easier, at least for what we're doing as algorithmic traders, because we're creating the rules, we're putting them in the software, we're getting results out, we're evaluating the results and making decisions, right? Here's an example. You know, would you feel comfortable trading this? Most people probably would. As opposed to, let's say your equity curve went like that. Would you want to trade that? Most people would say no. I mean, it's kind of common sense, but at the same time it isn't, because a lot of people, what they do is this. How do I draw nothing? They don't know. You know, they don't know if it goes up and looks good or goes down, looks good. They have just a big blank graph because they have no clue if it does good or it does bad. And that's crazy for a lot of us. That's why we test it. Because if you don't test, you know, you don't even know if you're aiming at the target, right? You could be shooting your arrow the wrong way. And, you know, just because I turn around take off the blindfold and now shoot it, doesn't mean I'm going to hit the bullseye. I might still miss, especially if maybe my arrow's bent or my bow is off, right? Just like if your system is bad or you over optimize, you still might miss the target completely, but you have a much better chance than this blindfolded guy because he doesn't even know where the target is. That's how most people trade, most retail traders at least. The pros, not so much, but the retail traders, yeah, that's what they do. All right, and that kind of leads us to our first don't. So we have had a couple of things to do. Build your strategy, test it. Don't number one is independently testing it. What do I mean by that? Well, you'd be amazed how many people think these are valid testing approaches. They read about a back test in a book or in a magazine or on the internet, or somebody shows you an equity curve like I just showed you, and you accept it as real. And you say, hey, Kevin, give me the code for that. I'm going to go off and trade it. And you never verify anything because, oh, well, he tested it. It was in the book. Oh, a lot of people do that. That's bad. Can't accept it as real. You can't accept what some guru says works when there's no back test. I'm astounded by the people. It seems like price action traders fall into this a lot, where there's a couple people who show all kinds of price action patterns, and yet if you were to go and test those, most of them would be 50-50 at best. There's no edge to most of those, yet they claim there is, and if you call them on it, they'll say, well, you can't really test that. So you can't do a back test, so therefore just believe what I say. People fall for that. That's not what we do. And people I work with, they learn that's not what you do. If you can't test it, don't trade it. And then the last one, a lot of people think that if it makes sense, it'll work. Oh yeah, just when the price falls below the moving average, buy, because eventually it's going to come back up, or and people will have in their mind, oh yeah, that makes sense. Or other people will say, well, when it falls below the moving average, that's a good time to sell. Yeah, and that makes sense, and they just go off with it without ever evaluating it. That's just, it's just not good. Just not good to do this. Don't believe what you see unless you do it yourself. Don't accept anything as truth. Don't even accept what I'm saying unless you verify it, right? Go grab a book. Go grab one of your trading books and look at some system that's great. Program it, back test it, see what you get. See if you can verify the results. Don't accept just because it's in a book that says, oh, this is good, that it really is. Maybe it is. My experience, most of the time it isn't. I still remember one guy out there wrote a book and talked about a cigar trade where he was, end of the day, he pulls out a cigar to celebrate all his victories. And he gave this system to make a little extra money. And the funny thing was, I went and tested it, and I actually found the opposite system is what made money, not the way he described it. My point, I didn't accept it as truth. I went and tested it and verified it, or not. That's the only way. And you might say, well, why? Why do I have to redo what somebody else did? One reason is confidence. People say, hey, algo traders, you don't need, the psychology isn't important, and they're wrong. And part of the reason is because no matter what you're doing, you need confidence in it, right? And you get a lot more confidence if you're the one who tested it and you did it properly, that, oh yeah, hey, I know this is a good result, rather than, I think this guy did it right. I don't really know. So don't accept things as truth. You got to test for yourself. So, there's a few big takeaways today, and this is probably one of the biggest ones. As an algo trader, somebody wants to program strategies, and just make sure you test them yourself. Don't rely on anybody else. Do it yourself. And that leads right into the second don't is, well, most people test, you test incorrectly. Don't do that. Here's an example. This is how most people do it because this is the way most of the trading software out there is set up. They have 10 to 20 parameters, all kinds of rules and filters. And then each parameter has 5 to 10 values, sometimes even more. So let's just say you're a moving average. Oh man, I want 10 different moving averages, a 2, a 5, an 8, because I want to get the whole range and see what it looks like. So 10 parameters to optimize, let's say 5 values each. So that's a huge number of iterations. And then, I want as much data as I can, so I'm going to take all the data up until last night and put that in my back test. So I got 17 years of data. Oh, this is going to be great. So I throw it in the trading software. I might have millions of cases, or at least thousands or tens of thousands. And, maybe I even have to do some kind of genetic optimization because it's not going fast enough. I don't want to wait. I don't want to wait all weekend. That's what most people are thinking. And then I get the best case. Oh, moving average of 5, an RSI of 70. And then they go down the list of all 20 parameters they're optimizing. There's the best ones. Tomorrow morning, I'm going to start trading those. Now, hopefully, I can't hear you guys, but hopefully, at least some of you are laughing at that. Because that's wrong. That's just dead wrong. And unfortunately, the trading software makes it so easy. Oh, it's so easy just to click on that variable and then up pops the window, min, max, increment. Oh, I can optimize this, And it's so easy just to run an optimization with all the data or however you want. And people think, well, that's the right way to do it. Trust me, it definitely is not the way to do it. And I see a couple people are saying, hey, I've done that. That's the way I used to do it. Yeah, get away from that. Here's some don'ts with testing and testing incorrectly. Don't try to test with too many variables. 5 or less is probably even 5 might be too much. But, don't do 10 or 20. You're never going to get anywhere. And, don't test. If you're testing a stop loss, don't test every $500 stop loss, 501, where you're running 100 different values of it. Don't do that. Don't test with all your historical data. You got to leave data, and there's different ways of testing. I don't have time to talk about it all today, but the less data you use, sometimes the better, which is really a hard thing to grasp. And don't assume whatever your best case is historically is going to be the best case going forward. And the best example I can give of this is sort of trading related, but it's with mutual funds back when there's Money Magazine, Kiplinger's Personal Finance Magazine. I don't even know if those are around anymore. But I remember I used to every year get the end of the year copies of those where they'd list the top 5 performing mutual funds. And invariably I'd look at those. Oh yeah, those have got to be good ones. So I'd invest in those, right? I'd put my money with those top performers. I assumed exactly what this last point is. I assumed the best in the past, 3 to 5 years is going to be the best going forward. You know how many times that worked? Almost never. It never worked. The best would never stayed on top. Something else became the best. And you know, a lot of times with mutual funds, it was, hey, one of the advisors got lucky one year, then he gets all this money, doesn't know what to do with it, and his performance drops, and it comes back to the average of, you know, other guys. Still might be good, but the point is that was kind of an optimization. It just didn't seem like one, but I was taking a database of 1,000 funds and picking the best ones on some criteria. And just because it was the best in history doesn't mean it'll be the best going forward. Now, you might say, well, then why backtest? Because, well, there's ways to get not necessarily the best, but get something good enough, something more robust. There's all that kind of stuff that will help you, but you don't necessarily just want to pick the highest net profit or the lowest drawdown and go with it. All right, so far, what have we learned? Okay, learned you got to have the building blocks of the strategy, right? The entries, the exits. Eventually you want the position sizing, but not right up to begin, but you need to test those strategies. So you need a lot of blocks and you need to do a lot of testing, and then you know to actually avoid certain things when testing. Don't go with too many variables, that kind of thing. How do you put all that together? That's kind of do number 3. You got to have a process to build and test strategies. Okay, you have all the pieces, but you got to have a process, and the process has to be a couple things, a couple major points. First, it has to be objective. You can't have guesswork with this, where oh yeah, that sort of looks good, or I think that's okay. No, be objective. And the reason is, eventually you're going to use your results to improve your process. And if you don't have a process to begin with, if some strategies you test for weeks, other ones you test a real quick test, and you do a lot of other stuff with the first one but not the second, if you don't treat all the strategies equal, you're not going to be able to say what's a good strategy and what's a bad strategy, and that's going to hurt you. So you want it to be objective. You want it to be rigorous. You want to eliminate as many bad strategies as you can, right? Think about the person who never back tests. He'll come up with a strategy, and it's a world of possibilities. It could be good, it could be bad, doesn't know. At least if you have a good process in place, you can eliminate a lot of the bad strategies. Not all of them, because you never will, but you can eliminate a lot of the bad ones. Yeah, unfortunately, you eliminate some of the good ones too. There's almost no no test you can run that doesn't get rid of bad ones and some good ones. But that's much better than accepting good ones. You got to have something you can follow. It's got to be simple, right? If you have something complicated that's going to take you a year to create a strategy, you're not going to stick with it. You're going to get bored. You're going to circumvent it, and you're going to go off and do something easier. And it's got to work, right? I mean, that kind of goes without saying, but I keep saying this, you'd be amazed. And I can say this because I talk to a lot of traders, or at least email. I guess that's kind of talking nowadays, where people do all sorts of goofy things and never verify that it works or doesn't work. They'll just, oh, hey, I'm going to try this, but then they never get feedback that it works or doesn't work. You got to prove whatever you're doing to develop systems. You got to prove it works. And if it doesn't, you got to change. So for example, this is my process, and this is a kind of cartoon I drew. A of a factory. This is a factory, and what you got is on the left side you have ideas being dropped off. These are your building blocks, your entries, your exits. You put them together as strategies and you do some testing. I do walk forward, Monte Carlo, incubation, all these machines. Think of them as machines where you're taking a piece of metal and you're working on that metal, and then what comes out, if it's metal, could be a watch. Maybe you made watches. For me, it's trading systems, and what leaves and goes off are trading systems. Or, I didn't show it here, a big pile of scrap, of junk. You know, if you make the part wrong, you got to throw it away, right? Well, same way with ideas. A lot of the ideas, you'll test them and you'll find, oh, well, that idea doesn't work. And you got to throw it in the scrap heap. So that's kind of my thinking with a process. So drop off ideas, you run some tests, and you either get something good or you don't. It's pretty simple. Okay, so I broke my approach down into this, what I call a strategy factory. It's registered with the U.S. Patent and Trademark Office. It's just steps. And think of them as machines that you're working with in a factory. You know, you go step by step through it, and you start out with your goals. You end up with possibly strategies that you're running full size. And obviously the devil's in the details here, but you can see it's not terribly complicated. Each idea by itself, each little step is pretty simple. And what I found, and the reason I started doing this, is because I was making all sorts of mistakes. And I'm not going to go through each one of these, but these were some of the big ones that I kind of sat down and when my trading was going bad, and I looked at and I said, well, what am I doing wrong? Oh, yeah, I'm optimizing. Oh, I don't include slippage and commission. And I built my process around eliminating these mistakes and a whole bunch of other mistakes too. But these were some of the big ones. And that's a key to having a good process, right? You want to eliminate some of the things you're doing wrong. And once I did, I found out everything got a lot better for me. So for you, you want to find or you want to create that process. You know, you want to start developing strategies and testing them correctly. And then once you have that process, you want to have as many entries and exits as you can possibly find. And, you know, my book is that free book is a great starting point. It's actually entries and exits that I use, have used, continue to use. You know, I don't give a lot of details of, oh, use this with crude oil, use this with gold, because that's not the point of the book. The point of the book is more to give you ideas so you can go off and evaluate it anyways. And if I told you that, if I said use this one on crude oil, I would hope you wouldn't believe me, which sounds kind of weird, but I would hope you would want to test it for yourself and verify it, because that's what you should be doing. So you just want the raw material. You're going to go off and test them. And then whatever passes your process or your rules, your procedure, that's what you trade. You don't trade the flavor of the day that you read in a book or you saw on the internet that somebody said they had success with. I mean, you drive yourself crazy with that, because there's always people saying how much success they're having trading some new method. And then, you know, usually when you ask them details, they disappear. A lot of times, it's because their method wasn't that good to begin with. I've had plenty of people just kind of ghost me when I've asked for details, and I kind of conclude that maybe they're not even trading. But the point is, you'll be trading whatever passes your criteria. And then once you have that criteria, you just go and you develop more and more strategies, and you start taking advantage of diversification and trading multiple markets where they're not correlated. That's huge. That's probably the closest thing to a holy grail. Not any particular strategy, but the whole setup that you've got. I mean, there's your big edge that maybe no one else does. Nobody can test your strategies like you can, right? Once you learn how. So that kind of wraps it up. We got do number one, build a strategy, right? Take those building blocks, put them together. Do number two, historically test it. Don't rely on somebody else to do it. You do it. That's don't number one, is neglecting to do that. You want to test it. You want to test it yourself. You don't want to over optimize. You don't want to make things too complicated. You want to have a proper process if you're going to optimize. Some people don't even optimize. Be careful with that. And the key with all this is to have a development process and a test process that, one, you can do, and two, that kind of loops back and actually works, and you verify it works. Okay, so obviously, that's some of what I teach in my Strategy Factory workshop. I have one next week. It's next Tuesday, I believe. And if you decided you wanted to join up, you get immediate access to all the material. If you decide you don't like it, you can get money back guarantee. I have a money back guarantee. So you can look at it and say, ooh, this is going to be too complicated. You get your money back, no problem. I think I've had somewhere between 5 and 10 people over the last 4.5 years request their money back. So most people don't, but it's there. And then you get my personal support, which a lot of people say is probably the biggest thing. It's me dealing with you via email. We have a Skype call, and it can really get you on track. And another cool thing, by the way, with this workshop is if you sign up for a Tradestation account, you fund a Tradestation account, the course can be free. I have a commission rebate program with them. So if you just go to my website, up at the top you'll see Strategy Workshop. Just click on that. There'll be full details. That's how you get to it. And answers a bunch of your questions. So something to consider. If you need a development and test process, along with a whole bunch of other stuff, this would kind of get you on the right road. Okay, so with that, we have some time for questions, and then we'll do the book giveaway at the very end. So if you have questions now, just type them in, and I'll just start going through them. There were a bunch already. All right, the first one, James said, asymmetric entries and currencies are almost always wrong and lead to curve fitting, correct? Yeah, that's kind of what I found. The only place I use asymmetric entries or exits would be in the stock indices. I tend to bias the long side a little bit more. And another thing you could do with stocks tend to go up slowly and then crash real fast, come down real fast. So you could have some exits that reacted to short trades a little bit differently than long. But a lot of other markets, and it's not just currencies, but I've seen it, even things like crude oil. You think about the history of crude oil, it's gone up over time, but it goes up and down and up and down, and it's not like there's not this big upward bias. So symmetric strategies tend to work pretty good with that. JJ's asking, how many parameters or signals is too many on one system? A good rule of thumb, especially once you start doing this, is if you feel like you've put too much into it, you've probably already gone way past it. So, and it kind of sounds silly to say that, but it's a good mechanism for you to know when you're getting too complicated. I mean, I love systems that have one entry rule, one exit rule. I mean, that's pretty much the lowest you can get, right? Or you actually have one that can go long and then the symmetric one going short. That's really kind of one rule. What you want to avoid is the 10, 20 parameters to optimize. It doesn't mean you can't have a lot of filters on it, but even that, you start to get where you're just overcomplicating it. And you're basically like curve fitting to the past data. And there's a lot of noise in any market data, right? And what you don't want to do is put so much curve fitting on it that you're actually fitting to the noise. And a lot of you might be like, what does that mean, fitting to noise? It's hard to explain until you actually do it, but the general rule of thumb is if you keep things simpler, those will tend to work better going forward because you haven't put so many demands on it. A lot of people, they like to feel in control when they're trading, and this is algo or discretionary because they say, okay, well, the price has got to be above the 10-day moving average, and the 60-minute bar average has got to be, price has got to be above that, and the RSI has got to be a certain value, and I have to see this candlestick pattern, and this, and that, and that, and they think, yes, I'm forcing the market to comply, right? Because I'm not going to take a trade unless all those things are in place. And they think the more of that they do, the better off they are, and it's actually the opposite. Actually, the fewer demands you put on the market, the better off you are. And it's hard when you're looking at that back test to be thinking that way, but that's how you got to think. So, okay, here's another question from Alan. Have you ever traded with Interactive Brokers API? And I have not, but I know what you can do. I use Tradestation. Most of the people I work with use Tradestation, but Tradestation likes to hook you into their brokerage. But one of the things you can do is you can also send signals with some other software. So I use Ninja, for example, Ninja Trader, where I'll send a signal from Tradestation to Ninja, and that could go on. That could go to Interactive Brokers or any other brokers that you could use. And I use a different broker, but I haven't used the API at all. All right. Yep, a lot of people were saying, hey, I used to do the optimization. As Brandon said, it's a great way to build a system for the past. Mark's asking my opinion of dark pools. I don't trade stocks actively, so I'm not really concerned too much about that. But it's the whole way the stock market is set up now with all these exchanges and stuff. It's really tough for retail traders. There's always going to be somebody in front of you who's faster and who can get a half penny better or a penny better. Kind of makes it tough. So a lot of those, certainly the dark pools too, they don't help things because you can't really see what's going on. So James is asking, how do you keep track of strategies you've tested that failed so you don't test them again unknowingly? Do you have a system keep track? Yeah, I keep a log of systems I have that have passed. A lot of times there's just so many different strategies to test. I don't necessarily keep a log of all the ones that failed, but you could. But I'm sure I've tested some things in the past 6 months that I tested 5 years ago and probably still found didn't work. But sometimes it's good to revisit those things because you might find that, well, now the market's changed and maybe those things are better. Good example, every once in a while I look at equity curve trading, which isn't a strategy necessarily, but a few years ago, I wrote articles for Futures Magazine, which may be defunct now. Its website's gone, so I don't know what happened to it. But, and you can get those off my website, by the way, but it concluded that equity curve trading isn't too good to do. Well, I just looked at it again the past week just to make sure, and I basically redid all the analysis from scratch and still reached the same conclusion. But, sometimes it's good to go back and look at things again. Thanks for that, James. Rick saying, what is the next workshop after next Tuesday? I usually run these live every 2 months, so it would probably be the end of March. But if there's a couple things, if you sign up, there's people who sign up who can't make it live. Well, you still get the recording, so you'll still get to listen to it. And one of the things I offer everybody is all future online workshops. If you want to come again and again, you just tell me and I'll sign you up for it, and there's no cost for that. So let's just say you wanted to sign up for Tuesday and oh, I'm going to miss the last 2 hours. No stress, because I record it. You're going to get it that night. You can listen to whatever you missed, and then you can say, oh, I want to attend that live. The next time I have it, you can tell me and you'll attend it live, and everything will be cool. So I try to be real flexible on that, because I realize it's a whole day. It's a lot of work. I've actually have people stay up who are like in Singapore and Hong Kong, and God love them, they stay up all night listening to it, which I don't think I could listen to myself for 8 hours, but when I'm tired. All right. Larry just, he's offline now, but he asked if genetic optimization works. Do I use it or use exhaustive? I use exhaustive. Genetic basically finds, it says instead of doing 1 million iterations, you only have to do 1,000, and you'll find a good case. There's reasons in my process, I don't use that. So it's not to say you can't use it, I just don't. Daniel's asking, what data vendors do I use for my testing? Since I'm using it with Tradestation, they provide the data. So I use them. One important thing to keep in mind is you want to test and trade with the same data. So don't test with Tradestation data and then go off and run with CQG data. And you might say, well, wait, it's all the same, right? Well, no, it doesn't necessarily have to be the same. There can be differences because of rollovers with futures contracts and that kind of thing. So you got to be careful. Now, Forex data is probably even more of an issue because every Forex broker really has their own feed. So be careful with that. LeMay is asking, for walk forward testing, do I recommend 15 and 20 years of data? Twice now I've developed a strategy, and when I get to the complete walk forward, I see relatively poor performance in the early years until the strategy takes off. Would you abandon this strategy? Without seeing it, I don't really know, but anytime there's an area of bad performance, I factor it in. Now, I don't necessarily trade tests for 15 to 20 years, because there were, back 2007, 2008 was probably the tipping point for going from electronic markets, from pit trading. So the market's kind of changed a little bit. And sometimes even you can look at the data, especially on low, like 1 minute, 5 minute bars, and you can see a pretty major change as it transitioned. So I don't necessarily trade with that much data, but pretty much every strategy is going to have areas of poor or flat performance, and you just have to look at it as a whole. And I evaluate with all the data. If you have the data, you can't dismiss it, and then see how it does. And if it passes, again, it's objective. I take all the trades, run them, and if it passes my criteria, it's good to go. If it's not, hey, it doesn't matter when the bad trades happened at the beginning, at the end, at the middle. If they're bad, they're bad. Okay, Juan's asking, is it good when a strategy works on several instruments and long and short? Yeah, it is, but it's not I don't have it as a requirement. Some people do, and they say, oh, hey, a strategy is only good if it works on oil and the euro and soybeans and gold, all these different markets. And yeah, I mean, that could be nice. And certainly I think it would give you more confidence, but I also have a lot of strategies that only work well on one or a couple markets. And so I just go with them. Brandon's asking, and thanks for all your questions, by the way. We still got a bunch more, so I'm trying to get through them. Brandon's saying, I've heard good money management is key. Entries is less important. Good money management. And the other side of good money management doesn't make up for not having edge. What are your thoughts? Well, you've got to have a strategy that works and that has long-term profitable expectancy. So it's a long-term profitable strategy. And then you got to apply the right money management. Money management alone will not make you a winner. But that being said, you could have the best strategy in the world, and if you have poor money management, you're probably still going to lose. So you need both. That's the kind of the way I look at it. And if you don't have both, eventually one's going to get you. LeMay is asking about my incubation. Do I trade in sim mode, or do I perform a walk forward every few weeks? I have a process for when I do the walk forward, and then what I'll do is I'll just look at the strategy just about once a month when I'm waiting. That's kind of how I do it. After walk forward, what does Monte Carlo add in the analysis? Juan's asking. Simple, it just kind of gives you the probabilities of things occurring. So just because an equity curve was a certain way and looks a certain way historically doesn't mean that's what you're going to get. And the best example I have of that is a lot of people will have a strategy, oh, it's made money in the last 6 months, and then they go live and then they have a losing week and they say, oh, this strategy doesn't work anymore, and they throw it away. Well, what I'd want to know is, what were your chances that you were going to have a losing week? Do you even know? That's what Monte Carlo helps you do. Okay, Ecow, hopefully I pronounced your name right. How do you explain that you expect your system to stop working besides your detailed development process? Markets change, players change, other people might find the same thing you found and trade it away. Lots of reasons. There's no reason why it should continue to work forever. And those are just some of the reasons. Joseph's asking, what platform do I use? I use Tradestation. And again, most people I work with use it too, and a lot of them have used that rebate program to actually get my course paid off. All right. Wow, man, a lot of questions. This is great. I love it. So I'll try to answer questions. How many bars constitute good back test? Sammy's asking. I always find smaller time frames give the most profit. Is this always true? I actually, well, there's a couple different questions there. Bars in a back test, I like to do 5 to 10 years, and I always find longer time frames work better over that period of time. So it might just be something we're doing different, Sammy. What do you mean being tricked by look inside bar back testing? You did not have it on during back testing, right? Luciano is asking. No, you actually look inside bar back testing is kind of a detailed topic, and I don't have enough time to explain it, but you do want it because you want the prices inside a bar to be known to your strategy. That's the best way to put it. If you neglect it, you could get inaccurate results. So that's something I avoid. Rick's answering someone else's question. Thank you, Rick. And he said multi-charts works with IB. That would be an alternative. Juan saying backtest will not take into account news events. So algos should trade during those. I personally do because, uh, there were news events that happened in your back test that you just didn't know about, right? You could also just say, I'm excluding Fed announcements and get a historical database of all the Fed announcements and build your system where you don't trade during those. That would be accurate. What I wouldn't do, and what I personally don't do, is just because a Fed announcement's coming up, I don't turn my system off because I'm scared. Because what's the basis of that? Now I'm going against my back test. JJ's asking how I find ideas. I talk about this a lot in the workshop, and I actually have like a running bet with everybody that I guarantee them they're never going to run out of ideas to test. And I've had 2 people come back and after the workshop a while after and say, hey, I've run out of ideas. And so I give them some more things to places to look, and they get them. But you could subscribe to Technical Analysis of Stocks and Commodities magazine. If you do, you get archives of all past issues. You could spend a lifetime testing those things on different markets. That's just one place, but there's a lot of places you can do. Do I use dominant cycle type ideas at all? Rick's asking. Not really. I do some seasonal type stuff where, you could say that's kind of a dominant cycle, but that's about it. Mark's asking about learning futures. There are a couple of good introductory books. One is Carly Garner, Garner. She's actually one of my brokers, and I met her a couple of years ago when she was in Cleveland for a Cavs-Bulls game. She's a big sports fan, and she's great. She's, there's a lot of slimy brokers out there, and she's not. And anyway, she wrote a couple good books, good introductory books. I'd look at that. James is asking opinion on stop losses based on ATRs. Have you found success with this method? I use it sometimes. Most of the time I have not found success. But again, just because I've done it doesn't mean you should avoid it, right? You got to test for yourself. So thanks for asking that. Lets me reinforce that point. I'm going to have to cut it in about 5 minutes, but we do have a few more questions. George is saying, how would you interpret a nice simple strategy, a nice equity curve, accepted tanks for the last 6 months? Yeah, I mean, a lot of strategies in the past year might have gone flat or down. You just got to be careful if you're wanting to trade those, because it could mean the strategy's broken. It could just mean it's just having a down period. So that's kind of hard to say. LeMay's asking a thing about limited testing. Is there a way that limited testing cannot waste your time? Yeah, I mean, you don't have to do. That's one of the steps I do is I try to do some quick tests. You don't necessarily have to do those, but what I found is I eliminate a lot of bad ones right off the bat by doing it. And again, what language am I programming with? Alan's asking. Since I'm using Tradestation, it's called Easy Language. It's pretty easy. Luciano is asking about some walk forward software, StratOpt. No, as far as I know, Greg's still around. He's the guy who wrote StratOpt. It's a walk forward software for Tradestation. You just got to maybe keep bugging him. How competent do you have to be with easy language? Daniel's asking. What I always tell people, if you could program a simple strategy, if I tell you, hey, program me a breakout strategy, the last 10 bars to buy with a stop loss, if you could do that, you probably know enough to at least get going. And what ends up happening is I give you a bunch of code. I give you 7 strategies as part of the workshop, and you'll probably be working with some other students if you want. And what will end up happening is you'll start out looking at code, and then you'll be just bewildered by it, and then it'll start to make sense, and eventually then you can start modifying it and then coming up with your own ideas. So it's a process, but you don't have to be an expert by any means. Do I have materials for other platforms? Not really, because I just mainly stick with Tradestation, but the process I use kind of works with any platform. There are people who do Ninja or MT4 who use the same process. Patrick's asking about walk forward testing. I believe if you go to my website, there's a good article. If you go to the free article section, there's a good one on that. It's hard to explain real simply, so I apologize for that. But it's just a method to get more out of sample data, really, which is what you want. Matt's is saying when he tests, he gets a buy and sell on the same bar. Is that a problem? Yeah, and there's ways around it. You just have to adjust your strategy. But I've actually found that with some strategies, and I couldn't avoid it, and I end up trading them where it buys and sells immediately. And so you're like, oh, that's kind of stupid, because now I just bought and sold and lost money. Yeah, but to try to work around it was going to be much more work. That I just kind of went with it. So sometimes that happens. Fareed saying, do I allocate capital to equal? That's something you can do. You don't necessarily have to. It really depends on what you're aiming for. Some people do equal, some people don't. There is no right or wrong answer, really. Jerome is asking about fundamental data. Can you incorporate in strategies? With Tradestation, a lot of it you can. I think they even have a commitment of traders data. I've never really done it that much, but you could. You just got to be careful with it to make sure that you're not looking forward with it, where or it's a revised report and somehow you end up getting signals off the revised report, because that could be inaccurate. So you just got to be careful. A couple more questions and then we'll wrap it up. We'll go to the book giveaway. It's still coming up. Sorry. Jonathan, how does a new trader build a strategy if they don't know what things should happen for a successful strategy to work? A lot of that is you really just have to start testing and playing around with things and seeing things. And you gave a great example, Jonathan, of a moving average strategy. Everybody's pretty much heard of that. Well, that'd be the first thing I'd go and test. Probably was, actually. Go and try it and see what happens. And then you start to get a feel for, okay, well, maybe that's not what I want to do. I want to do a breakout. And then you start, a lot of it's kind of wandering without knowing exactly where you're going. But, like I said, I don't rely on others to say this works and then I never test it. But what I do is research, and I'll find a research paper that says, hey, the RSI seems to work if you do this, and then I'll go and use that to test. So I use that kind of as a starting point. I'll do a lot of that. Do I believe in using indicators other than moving averages and Bollinger Bands? Yeah, I'll use anything. Patterns, indicators, statistical stuff, all sorts of things. There really is if it works, I'll use it. How many trades would you like to see in the back test? Anders is asking. I base it not on trades per year, but I'll base it on the number of variables I have, because you want to, you don't want one trade per optimized variable, so that's kind of how I look at it. Raymond saying, any suggested resources for learning easy language? They do have some boot camps and stuff. Tradestation puts them on, but to start, I would just go to their website and just look for all their free stuff. I have a book I can send you if you send me an email. It was from Tradestation. It's probably 10 years old, but it's pretty nice. And it taught me a whole lot. All right, we're getting towards the end. So a couple more questions, then we're going to wrap it up. Fareed saying, can you put trade results in pips to neutralize position sizing? Yeah, I mean, you just got to be careful that what you're looking at is actually based on the same standard, you know. That's the key thing with not using position sizing in testing, at least as far as I'm concerned. How much computing power do you use? I test most of my stuff on either a 4-year-old desktop or a 7-year-old laptop. So uh, one thing I caution people is if you think you need a faster and faster computer, maybe take a step back and ask yourself if maybe what you're doing is too complicated. Maybe it isn't, and maybe you need a really fast one, but that might be something to look at. How long does one strategy last for you? Anders is asking. And how often do you optimize? I optimize based on my walk forward schedule, so that might be every 6 months, might be every year. And I have some strategies that have worked for 10 years or so, you know, and I have some strategies that only work for a year, some that work less. You know, usually the big thing I do is I plan on them eventually breaking. So I put something in place to say, hey, I'm going to stop it before it drains my account. And that's the key. How many years would you like to see in backtest? I like to see 5 to 10 years. And with that, I think that was the last question. All right, so that's probably it. Thanks for sticking around. Wow, that was a lot of questions, but I like that. All right, so get ready. It's going to be the third correct answer to the following question, and the person who gets this, the third correct answer, I'll autograph the book. You know, send me an email afterwards. Tell me you're the winner, and I'll obviously know your name, and I'll send this off to you. And actually, this is not the book I'm sending. That's kind of funny. I put the wrong graphic up. You're going to be getting the paper version of my Building Winning Algorithmic Trading Systems book. This one you can get for free. It's a PDF book. It's not even there's no way I could autograph it. Okay, third correct answer. Name one of the do's that I presented. Okay. Backtest, build a system test. It looks like Stefan, looks like you were the third correct answer. So send me an email and I will get that off to you. And again, there were 3 do's, there were 2 don'ts. If you do those, if you just keep those in mind with the building blocks I gave you in this little book, you can be off to a good start. So with that, I just want to say thanks. Thanks for attending. Thanks for sticking with us for almost an hour and a half. This was pretty good. And I am going to be doing another one. It's going to be a part 2 of do's and don'ts. And a lot of these do's and don'ts were kind of higher level. And the next time I do it might be in a month or two. We're going to get into some different stuff. So again, thanks for coming. I'll let you guys go, and you'll be getting the recording shortly. All right. Thanks, everyone.